Preparing for a financial analyst at Telenor interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does a financial analyst do, and why are you interested in Telenor? A financial analyst turns operational information into decisions about performance, investment, and resource allocation. I am interested in Telenor because telecommunications combines recurring revenue, significant infrastructure investment, competitive pricing, and measurable customer behavior. I would enjoy analyzing results, challenging assumptions, and explaining financial implications to non-finance stakeholders. The role also appeals to me because disciplined forecasting and capital allocation directly influence network quality, customer experience, profitability, and long-term shareholder value. While answering, focus on financial analysis, planning, performance reporting, decision support, and stakeholder communication. Connect your motivation to Telenor's telecommunications scale, data-driven culture, customer impact, and need for disciplined capital allocation. Question 2. Walk me through the three financial statements and how they connect. The income statement shows revenue, expenses, and profit over a period. Net income flows into retained earnings on the balance sheet and starts the operating section of the cash flow statement. The balance sheet presents assets, liabilities, and equity at a point in time, while cash flow reconciles accounting profit to changes in cash through operating, investing, and financing activities. For example, depreciation reduces profit but is added back in operating cash flow and lowers fixed assets. Make sure to cover the income statement, balance sheet, and cash flow statement, explaining profit, assets and liabilities, cash movements, retained earnings, working capital, depreciation, and the importance of cross-statement consistency. Question 3. How would you build a monthly financial forecast for a telecommunications business? I would begin with historical actuals and identify operational drivers rather than simply applying a growth rate. Revenue could be forecast from subscribers, average revenue per user, usage, and churn. Costs would reflect traffic, personnel, vendors, energy, and network activity. I would model CapEx separately, incorporate seasonality, and validate assumptions with commercial and operational teams. Finally, I would produce base, upside, and downside cases, then refresh the forecast using monthly variances. In your answer, talk about historical trends, operational drivers, revenue categories, subscriber metrics, costs, CapEx, seasonality, management assumptions, scenario analysis, variance feedback, and documented ownership of key inputs. Question 4. How do you investigate a significant variance between actual and budget? I first confirm that the variance is real by checking the ledger, reporting period, mapping, and any accruals or reclassifications. Then I separate volume, price, mix, timing, foreign exchange, and one-off effects. For example, a revenue shortfall may reflect fewer subscribers, lower usage, or delayed billing. I would discuss the root cause with the business owner, quantify whether it is temporary or structural, update the outlook, and recommend an action. Be sure to mention materiality, timing, volume, price, mix, foreign exchange, accounting classification, one-off items, operational drivers, source data validation, root cause ownership, and corrective actions. Question 5. Which KPIs would you monitor for Telenor's mobile business? I would track service revenue growth, subscriber additions, churn, ARPU, data usage, customer acquisition cost, EBITDA margin, operating cash flow, and CapEx intensity. I would also include network availability, customer satisfaction, and complaint levels because financial performance depends on service quality. Importantly, I would connect the metrics. Higher data usage may support revenue, while promotions can increase additions but reduce ARPU. The goal is understanding drivers, not merely reporting isolated numbers. Focus on subscriber additions, churn, ARPU, revenue growth, service revenue, data usage, EBITDA margin, cash flow, CapEx intensity, network quality, customer satisfaction, and how operational KPIs translate into financial outcomes. Question 6. What is EBITDA, and why is it important in telecom analysis? EBITDA is earnings before interest, tax, depreciation, and amortization. It helps compare operating performance before financing choices and non-cash depreciation, which is useful for asset-intensive telecom companies. However, I would never treat it as cash flow. Networks require substantial CapEx, spectrum costs, lease payments, taxes, and working capital. I would review EBITDA alongside operating cash flow, free cash flow, leverage, and return on invested capital to assess economic performance properly. While answering, define EBITDA, explain its usefulness for operating comparisons and leverage analysis, distinguish it from cash flow, and mention limitations involving CapEx, spectrum payments, leases, working capital, and accounting differences. Question 7. How would you evaluate a proposed investment in a new telecom network project? I would build an incremental cash flow model, separating initial CapEx, rollout timing, maintenance costs, energy, spectrum-related expenses, expected customer adoption, ARPU, savings, taxes, and terminal assumptions. I would calculate NPV using an appropriate discount rate and review IRR and payback as supporting measures. Sensitivities should include adoption, pricing, CapEx overruns, and rollout delays. I would also capture strategic benefits, such as coverage, retention, and capacity, without allowing them to hide weak economics. Make sure to cover incremental revenue, cost savings, CapEx timing, operating costs, customer adoption, useful life, tax, working capital, discount rate, NPV, IRR, payback, sensitivities, and strategic benefits. Question 8. Explain the difference between operating cash flow, free cash flow, and EBITDA. EBITDA measures operating earnings before depreciation, amortization, interest, and tax, but it ignores cash timing and investment needs. Operating cash flow starts with accounting earnings and adjusts for non-cash items and working capital movements. Free cash flow generally equals operating cash flow minus capital expenditure, showing cash available for debt reduction, dividends, or reinvestment. In telecom, the gap between EBITDA and free cash flow can be substantial because network investment is recurring and strategically important. In your answer, distinguish earnings from cash generation, explain working capital and non-cash adjustments, define free cash flow after capital expenditure, and discuss why telecom analysts monitor all three measures together. Question 9. How would you assess whether customer churn is becoming a financial problem? I would analyze churn by customer segment, product, geography, tenure, and contract type rather than relying on one overall percentage. I would compare lost revenue and lifetime value with retention costs and replacement acquisition costs. A small increase in churn may be manageable if high-value customers remain stable, while low-value churn could still signal broader service issues. I would examine cohorts, competitor promotions, network quality, ARPU, and the resulting revenue and EBITDA forecast. Be sure to mention churn trends, customer segments, acquisition costs, retention spending, ARPU, lifetime value, gross additions, cohort analysis, competitor activity, and the resulting effect on revenue, margin, and cash flow. Question 10. What would you include in a management performance dashboard for Telenor? I would design the dashboard around decisions, not data volume. It would show service revenue, EBITDA, free cash flow, CapEx, subscribers, churn, ARPU, data usage, customer satisfaction, and forecast versus budget. Each metric would include trend, variance, target, owner, and a concise explanation of the driver. I would allow drill down by market, product, and customer segment, while documenting definitions so managers trust the data. Every red indicator should lead to an action. Focus on a concise combination of financial and operational metrics, targets versus actuals, trends, forecasts, variance explanations, traffic light alerts, segment views, data definitions, and clear actions for management. Question 11. How would foreign exchange movements affect Telenor's reported performance? Foreign exchange can affect transaction costs, foreign currency debt, and the translation of overseas subsidiaries into the reporting currency. I would separate operational performance from translation effects by comparing reported results with constant currency growth. I would also review whether revenue and costs are naturally hedged, quantify sensitivities, and understand existing financial hedges. When presenting results, I would explain both the reported movement and the underlying business trend so management does not confuse currency volatility with operational improvement. In your answer, distinguish transaction and translation exposure, identify affected revenue, costs, debt, and investments, explain constant currency reporting, and discuss sensitivities, hedging, and communication of underlying performance. Question 12. What accounting issues would you consider under International Financial Reporting Standards 16 for a telecom company? Under International Financial Reporting Standards 16, most leases create a right-of-use asset and lease liability rather than a simple operating lease expense. For telecom, I would pay particular attention to towers, network sites, offices, vehicles, and equipment arrangements. The accounting shifts expense from operating costs into depreciation and interest, often increasing EBITDA without changing total cash payments. I would validate lease terms, renewal options, discount rates, modifications, and completeness, then explain the effect on leverage and cash flow. Make sure to cover right-of-use assets, lease liabilities, discount rates, tower and site arrangements, EBITDA impact, depreciation and interest, lease modifications, exemptions, and cash flow presentation. Question 13. How does International Financial Reporting Standards 15 affect revenue recognition in telecommunications? International Financial Reporting Standards 15 requires revenue to be allocated to distinct performance obligations based on relative standalone selling prices and recognized when control transfers. In telecom, a handset and a service contract may be separate obligations, so revenue timing can differ from customer billing. I would assess discounts, upgrades, activation fees, contract modifications, contract assets, and contract liabilities. The key analytical point is reconciling reported revenue with bookings, cash collections, subscriber volumes, and contractual economics. While answering, cover performance obligations, bundled devices and services, allocation using standalone selling prices, contract modifications, activation fees, contract assets, contract liabilities, and timing differences between billing and recognition. Question 14. How would you use Excel or financial systems to improve reporting accuracy? I would use a controlled data structure with standardized account mappings, clear input areas, locked formulas, and separate assumptions from outputs. I would reconcile totals to the general ledger and build checks for missing data, duplicate records, unexpected movements, and balance sheet consistency. Where possible, I would automate recurring imports and reporting through approved systems or Power Query. I would retain version history, document key logic, and ensure another analyst can reproduce the result. In your answer, talk about structured data, source controls, standardized templates, formulas, reconciliations, version management, automation, exception checks, audit trails, and avoiding excessive manual spreadsheet dependencies. Question 15. Tell me about a time you improved a financial reporting process. In a previous reporting process, analysts manually copied monthly figures across several files, creating delays and inconsistent formulas. I mapped the workflow, identified recurring data sources, and built a standardized template with automated imports, validation checks, and a reconciliation to the ledger. I tested it with the reporting team, documented the process, and added ownership controls. The result reduced preparation time, improved consistency, and allowed analysts to spend more time explaining variances rather than assembling data. Be sure to structure the example around the original problem, your analysis, stakeholder collaboration, control improvements, measurable time or accuracy benefits, and how you ensured the solution remained sustainable. Question 16. How would you analyze the financial impact of a pricing promotion? I would compare the promotion with a no-promotion baseline and model incremental subscribers, ARPU, usage, discounts, device subsidies, retention, and variable costs. I would calculate contribution margin, customer acquisition cost, payback period, and lifetime value, while testing cannibalization of existing customers. The analysis should include duration, contract terms, competitor reactions, and downside uptake. A promotion is attractive only if the incremental customer economics and strategic benefits outweigh the near-term revenue and margin dilution. Focus on incremental subscribers, ARPU dilution, usage, retention, cannibalization, acquisition cost, margin, contract duration, payback, customer lifetime value, competitor response, and sensitivity to uncertain uptake. Question 17. How do you prioritize competing requests from finance and business stakeholders? I prioritize requests by deadline, financial or regulatory risk, decision impact, dependencies, and effort required. I clarify the purpose and minimum useful output, then agree priorities with my manager when demands conflict. For urgent work, I provide a reliable first version and state assumptions or limitations clearly. I keep stakeholders updated rather than missing a deadline silently. This approach balances responsiveness with control quality, which is especially important in recurring reporting and forecasting. Make sure to mention materiality, decision urgency, regulatory or reporting deadlines, effort, dependencies, stakeholder alignment, transparent communication, realistic timelines, and protecting quality rather than silently accepting impossible workloads. Question 18. What would you do if a senior stakeholder asked you to change an unfavorable forecast without evidence? I would first understand the stakeholder's reasoning and ask whether new evidence supports a different assumption. If appropriate, I would update the forecast transparently and document the basis. If the request simply aimed to make results look better, I would explain the risk of misleading management and present the evidence-based forecast alongside an upside scenario. I would involve my manager or control function if necessary. Maintaining credibility matters more than producing a convenient number. In your answer, emphasize integrity, evidence-based assumptions, respectful challenge, documentation, scenario presentation, escalation through appropriate channels, and the distinction between legitimate judgment and manipulating reported information. Question 19. How would you explain a complex financial result to a non-finance manager? I would begin with the headline, what changed, by how much, and whether it matters. Then I would explain the result through operational drivers, using a simple bridge or one clear example. For instance, I might show that lower EBITDA resulted mainly from energy costs and weaker ARPU rather than unexplained overspending. I would avoid accounting jargon, distinguish temporary from structural factors, and finish with the forecast implication and recommended management action. Focus on starting with the headline, using plain language, linking financial outcomes to operational drivers, quantifying material effects, avoiding jargon, checking understanding, and ending with implications or recommended actions. Question 20. Why should Telenor hire you as a financial analyst? Telenor should hire me because I combine strong financial discipline with curiosity about how operational decisions create results. I can build and review models, investigate variances, communicate clearly, and challenge assumptions constructively. In previous work, I improved reporting accuracy while meeting tight deadlines and collaborating with non-finance colleagues. I also understand that a telecom analyst must connect subscribers, churn, ARPU, network investment, and cash flow. I would bring ownership, integrity, and a practical decision support mindset. Be sure to combine technical competence, commercial curiosity, accuracy, communication, ownership, teamwork, ethical judgment, and enthusiasm for telecom economics. Support strengths with one concise example rather than making unsupported claims. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.